As the U.S.-Iran conflict injects massive volatility into global energy markets, renowned investor Louis Navellier is urging traders to skip popular energy ETFs like the United States Oil Fund, or USO, and the United States Brent Oil Fund, or BNO. Instead, Navellier advises that investors should, quote, prefer individual stocks, end quote, specifically recommending refiners like Phillips 66, ticker PSX, to capitalize on the 2026 energy crunch. Navellier, founder and chief investment officer of Navellier and Associates, is taking a firm stance against broad commodity funds amid surging volatility. Quote, I do not recommend any energy ETFs, and I prefer individual stocks, end quote. Instead of tracking geopolitical risk through exchange-traded funds, Navellier is targeting downstream players that are positioned to capture high margins. He noted, quote, I do recommend refiners like HF Sinclair Corporation, or ticker DINO, and PSX due to strong forecasted sales and earnings, end quote. This sentiment regarding the structural risks of ETFs is echoed by Batunic's exchange analyst Dean Chen. Chen warns that funds like USO and BNO carry significant futures rollover risks. If the U.S.-Iran conflict suddenly de-escalates and supply chains normalize, the futures curve could flip into contango, generating painful negative roll costs for long-term ETF holders. While geopolitical tensions and naval blockades have pushed crude prices to near-term highs, Navellier does not foresee a sustained runaway rally driven by the conflict alone. Instead, he expects strong seasonal factors to support prices, projecting WTI crude to remain high, up to $82 a barrel for WTI, and that is through the Labor Day due to peak worldwide demand. However, he dismissed the longevity of the war-driven price premium. Quote, the recent uptick in crude oil prices due to the resumption of the U.S. tax on the IRGC is expected to be temporary, since the IRGC is being systematically neutered, end quote. Navellier's preference for individual refining stocks like PSX aligns perfectly with a broader structural shift in the energy sector. With approximately 10% of global refining capacity currently offline, active refiners are posting historic profit margins. As Chen summarized, quote, in 2026, global oil pricing is no longer determined only by how much crude exists underground, but by the physical limits of alternative trade routes and whether critical energy infrastructure can survive geopolitical conflicts, end quote. For now, experts agree that investing directly in resilient refining infrastructure offers a stronger tactical advantage than simply betting on crude futures. So a good idea there. I think there's a place for ETFs. I think one of the things that they're getting at here is that if you don't time that move exactly, you might actually be incurring more risk with the way that some of these ETFs actually work. And as an alternative, you might want to take a look at refiners as opposed to oil producers.